What exactly is a cryptocurrency? Cryptocurrency is a type of digital currency that is not tied to any particular country or government. Instead, who owns what is recorded on computerized systems protected by strong cryptography and blockchain technology. Before we get started, please like this video and subscribe for more videos on the Wise Thinking channel. While cryptocurrencies can be used to buy day-to-day items in some stores, it is more commonly traded as digital assets as a way to profit from investment returns. On cryptocurrency exchanges, you can make a lot of money by buying and selling. However, because prices are so volatile, you could lose money as well. When cryptocurrency prices dropped, some people lost a lot of money. In this video, we go through some cryptocurrency trading tips. What causes the price of cryptocurrencies to fluctuate? Cryptocurrency, like all financial markets, goes up and down. The cryptocurrency market, on the other hand, varies from the stock market in terms of volatility because it moves very quickly. These changes can be frightening, but for some cryptocurrency investors, they are the key to making money. This implies that it is critical to try to understand what makes prices move. Here are some of the main catalysts for price changes. Media coverage. Crypto traders are avid readers of press coverage of their coins. Either positive or negative news can cause them to buy or sell coins, moving the market very quickly. Integration. Cryptocurrencies are becoming increasingly mainstream as a medium of exchange for buying goods. And as they are accepted by more outlets and are integrated into more banking and payment systems, the prices tend to rise. Wider events. Political events and government decisions relating to cryptocurrencies also move the market. For example, when China put in more stringent rules on Bitcoin mining, the price of the currency fell dramatically. Unlike stock markets, which are only open during particular hours on weekdays, cryptocurrency can be exchanged at any time. Tip: when it comes to investing, we always encourage having a long-term approach, especially with less traditional options like cryptocurrencies. If you're new to investing, have a look at our step-by-step approach. What are the different crypto trading strategies? Those attempting to profit from cryptocurrency trading employ a variety of tactics. The following are a few of the most important. Day trading is the first option. This is a fast-paced type of cryptocurrency trading in where investors buy and sell cryptocurrencies multiple times each day in order to profit on short-term price fluctuations. This, however, may not be the case. When attempting to timing the market, there is a risk of losing money. Hedging is number 2. Hedging is a strategy adopted by certain crypto traders who want to hold the coins but not be overexposed to volatile swings. It involves one of your assets cancelling out some or all of the risk of losses with another. Financial products such as contracts for difference and futures can be used to hedge cryptocurrencies. You may effectively wager on the future price of currencies with them. This is a risky tactic that should only be employed if you're confident in your abilities. Hodling is the third step. Those that hodl a cryptocurrency preserve it in their possession during good times and bad. On an early Bitcoin forum, there was a blunder. However, it is frequently explained in retrospect as meaning for holding on for dear life. It's customary for investors to use a buy and hold approach when it comes to traditional assets. 4. Investing in trends. Crypto traders use trend trading to select whether to buy or sell specific currencies based on whether their price is rising or falling. There are many more complicated theories on how to spot a trend or predict when it will shift. However, the underlying principle is that these cryptocurrency traders purchase when the market is rising and sell when it is falling. The problem arises in determining which is which. Aware of the numerous cryptocurrency-related frauds that can be found on the internet and elsewhere. The Financial Conduct Authority, which oversees UK investments, recently issued a warning about the increasing number of cryptocurrency frauds and offered advice on how to avoid them. Which cryptocurrency should I put my money into? Some of the most well-known cryptocurrencies are Bitcoin and Ether. However, there are thousands to pick from now. There are several variables to consider while selecting the best cryptocurrency for you. Fundamental analysis assesses an asset's intrinsic value, which is more difficult to do with crypto. You must also consider risk management. This is where you think about the things that could jeopardize your investment. What are the risks associated with cryptocurrencies? Cryptocurrency traders should be aware of the dangers. Crypto, as previously said, is a volatile asset with a rapid price drop. Other risks include the possibility of losing all of your money to a con artist. It's also possible to lose your password to the digital wallet where you keep your cryptocurrencies, or the hard drive where you save your valuable money. On all fronts, there are cyber threats. The area between the keyboard and the chair, or the smartphone and the digital wallet, is as crucial as the crypto custodian's cyber hygiene and defenses, just as cyber threats increase according to Moore's law. While the Bitcoin blockchain has shown to be one of the most cyber-resistant developments to date, the companies that plug into it, like other cryptocurrencies, are frequently newcomers with lax cybersecurity standards and resources. In terms of traceability, transaction logging, and levels of trust or fiduciary duty, not all cryptocurrencies are created equal under this standard. For this, threats as basic as unexplained disappearance and as complicated as ransomware attacks and AI-powered bots combing the internet must be considered. The internet is a complicated and fast-moving threat for weak links and easy targets. Human error and forgetfulness, due to the intangible nature of the asset class, human error and something as perplexing as password forgetfulness can result in the complete loss of a cryptocurrency fortune. Not everyone is as fortunate as 50 Cent, who discovered a $8 million Bitcoin bounty after forgetting to take Bitcoin for an album release. The threat of getting locked out, losing hardware, or encountering geophysical risks like spilt coffee is often enough to cause losses, not to mention the ever-present risk of buyer's remorse due to Bitcoin price volatility. The high-profile character and public quality of significant asset holders at the crypto whale end of the market may expose people to direct physical harm. Kidnapping, ransom, and extortion are examples of such crimes. A fleet of Lambos will not add to the necessary prudence in order to avoid becoming a target. Safe, UN, habitats, the absence of coordination and clarity on regulatory, financial, tax, and legal handling of cryptocurrencies, and this asset class in general, is another major danger. Given the relatively recent nature of this industry and the typically poor and lagging quality of regulatory catch-up, this is unsurprising. Indeed, most regulators throughout the world did not begin to form a judgment regarding cryptocurrencies until Bitcoin's spectacular climb to prominence in 2017. Suddenly, countries and jurisdictions all over the world have launched a crypto land grab, vying to become the preferred site for potential investors and enterprises. Like the global financial system, coordination and coherence can help to avoid systemic and mundane hazards while also increasing overall market stability.